2 weeks ago, I was reading through a quarterly 13F filing. Not exactly beach reading. A 13F is the document institutional investors, hedge funds, pension funds, asset managers controlling billions, are legally required to file with the SEC every quarter disclosing their equity holdings. Most people never read them. They're public. They're free. They sit on the SEC's Edgar database waiting for anyone curious enough to look. And buried inside the most recent round of filings, I noticed something. Not one fund. Not two. Multiple major institutional investors quietly increasing positions in the same 7 categories of stocks. Not announcing it. Not publishing research about it. Not going on CNBC to talk about it. Just steadily, methodically, quarter after quarter, accumulating. That pattern has a name on Wall Street. It's called smart money accumulation. And historically, when institutional money moves in this particular way, quietly, consistently, across multiple independent funds simultaneously, it tends to precede something significant. I want to be precise about what I mean by significant. Not a get-rich-quick event. Not a guaranteed moonshot. Significant as in, these sectors and companies have structural tailwinds building through 2026 and 2027 that the data suggests most retail investors are significantly underexposed to right now. My name is Money Sketcher, and I sketch out the financial patterns most people miss until the opportunity has already passed. If you've ever wondered what the people managing billions of dollars are actually doing with that money right now, subscribe, because today we're reading the same filings they file and following the actual trail. Important disclaimer before we go any further. I am not a financial advisor. Nothing in this video is financial advice or a recommendation to buy or sell any security. This is pattern analysis based on publicly available institutional filing data. Every investment involves risk. Do your own research. Consult a qualified financial professional before making investment decisions. Past institutional accumulation patterns do not guarantee future returns. With that clear, let's sketch it out. Before we get to the 7, I need to spend 2 minutes on why this data is worth your attention in the first place. Every quarter, any institutional investment manager controlling more than $100 million in equity assets must file a 13F with the SEC within 45 days of the quarter ending. This filing lists every equity position they hold. Every stock. Every share count. Every dollar amount. It's mandatory disclosure. Which means it's not opinion. It's not analyst prediction. It's not someone's hot take on a podcast. It's legally attested documentation of where the actual money is actually sitting. The limitation is the 45-day lag. You're seeing where the money was, not necessarily where it's going. Sophisticated readers account for this by looking for consistency across multiple quarters rather than single quarter moves. A position that appears once might be tactical. A position that grows for 3 consecutive quarters across multiple independent funds is a different signal entirely. That's what I'm looking for. And that's what I found. Here's the second reason this matters. Institutional investors have research resources that individual investors don't. Teams of analysts. Industry experts. Proprietary data. Access to management. When they accumulate quietly rather than loudly, it's usually because they've done work that hasn't yet shown up in public consensus and they prefer to finish building their position before the crowd arrives. Reading 13FS is essentially reading their homework after they've done it but before the test is graded. Now, with that context, here are the 7. Everyone knows about the AI story at this point. NVIDIA became the most discussed company on Earth. Microsoft's partnership with OpenAI saturated the financial press. The obvious AI plays have already had their obvious runs. What the 13F data shows is that institutional money has quietly rotated into the second layer of the AI infrastructure trade. Not the chip designers at the top of the value chain. The companies that build and operate the physical infrastructure the chips actually run in. Specifically, data center real estate investment trusts and the power utility companies serving them. Here's the supply chain reality that institutional analysts have been modeling for 18 months. A single AI training run for a large language model consumes approximately the same electricity as 130 homes use in an entire year. The data center capacity required to support projected AI workloads through 2027 will require somewhere between 40 and 50 gigawatts of new power generation. To put that in context, that's roughly half the current total electricity generation capacity of the United Kingdom. The companies positioned to supply that power and that real estate are seeing institutional accumulation that the headline AI narrative hasn't yet caught up to. The 13F pattern, multiple large funds including Vanguard's active equity division and several major pension funds have been increasing positions in data center REITs and regulated utilities serving high-density computing regions for 3 consecutive quarters. Why this matters for 2027? The AI infrastructure build-out has a multi-year demand curve with limited near-term supply response. The physical infrastructure can't be built overnight. Companies already positioned in this supply chain have a structural advantage that the market hasn't fully priced. The geopolitical environment through 2027 has created a defense spending cycle that most retail investors are engaging with at the surface level. Lockheed Martin, Raytheon. The names everyone already knows. The 13F accumulation pattern tells a more specific story. NATO member nations collectively committed to spending 2% of GDP on defense. Most are significantly below that target and face political pressure to close the gap by 2027. The specific categories of spending driving that commitment are electronic warfare, unmanned systems, satellite communications, and cybersecurity infrastructure. The institutional accumulation has been concentrated not in the large prime contractors but in the Tier 2 defense technology companies. The ones doing the specialized electronics, the software-defined systems, the satellite bus manufacturers, the electronic warfare specialists. These companies have longer order backlogs, higher margin profiles, and lower public profile than the household defense names. They also have a structural tailwind that doesn't depend on any single conflict or political outcome. It depends on treaty commitments that 32 nations have already made. The 13F pattern, position sizes in this Tier 2 defense technology category have grown for 4 consecutive quarters across pension funds, sovereign wealth fund proxies, and several major endowment managers. Why this matters for 2027, government procurement cycles are slow and predictable. Orders placed today generate revenue through 2026 and 2027. The backlog visibility in this sector is among the highest of any sector in the equity market right now. The demographic math of the United States and most developed economies through 2027 and beyond is not complicated. It is simply large and mostly underappreciated. The last of the baby boomers turned 65 in 2029. Between now and then, approximately 10,000 Americans are turning 65 every single day. That has been true since 2011 and will continue for the next 4 years. The healthcare system is structurally undersupplied for this demand. Not in the dramatic crisis way that makes headlines. In the quiet, compounding way that creates sustained revenue growth for the companies positioned to serve it. The institutional accumulation pattern isn't in pharmaceuticals or hospital systems. It's in 3 specific subcategories: home health and hospice services, medical device companies serving orthopedic and cardiovascular needs in the 65-plus population, and the healthcare REITs owning senior living and skilled nursing facilities. These aren't exciting companies. They don't go viral. They don't get written up in Reddit threads. They provide services to an aging population that will need those services with increasing urgency regardless of economic conditions, interest rate environments, or political outcomes. That recession-resistant demand profile combined with a structural demographic tailwind is exactly the kind of setup that institutional money accumulates quietly and holds through volatility. The 13F pattern, this subcategory has seen net institutional buying for 6 consecutive quarters. The consistency of that accumulation is unusual. 6 quarters of net buying suggests this isn't tactical. It's a strategic multi-year position. This is the one that surprises most people. And it's the one where the gap between institutional awareness and retail awareness is perhaps the largest. Water is the most critical resource infrastructure in the world. And it is systematically underfunded and aging in most developed economies. The American Society of Civil Engineers gives U.S. water infrastructure a D+ grade. The EPA estimates the U.S. needs $625 billion in water infrastructure investment over the next 20 years. Approximately $50 billion of federal funding has been allocated through the Infrastructure Investment and Jobs Act. The gap between what's needed and what's funded is enormous. And that gap gets filled by the private companies operating water utilities, water treatment technology, and water testing services. Globally, the picture is similar. Water stress is projected to affect 40% of the global population by 2030 according to UN estimates. The companies providing water purification, distribution, and treatment technology have a demand curve that is both long-dated and relatively price inelastic. People pay their water bills. The 13F pattern, water utility companies and water technology firms have appeared in the accumulation lists of several major endowment managers and ESG-focused institutional funds for 5 consecutive quarters. The ESG angle has actually increased institutional interest beyond pure financial analysis because water security appears in the mandates of several major sovereign wealth funds. Why this matters for 2027, infrastructure spending has long timelines, but once allocated, it's remarkably predictable revenue. Companies already embedded in the water infrastructure supply chain are positioned for a decade of government-funded demand. The supply chain disruptions of 2020 through 2022 created a political and corporate consensus around supply chain resilience that has since translated into concrete capital allocation. The CHIPS Act. The Inflation Reduction Act's manufacturing provisions. The reshoring of semiconductor production. The onshoring of pharmaceutical active ingredient manufacturing. The rebuilding of domestic battery supply chains. This isn't a trend. It's a policy. And policy-driven capital allocation is among the most predictable demand sources in equity investing because it has legal and regulatory force behind it. The institutional accumulation hasn't been in the headline companies breaking ground on new fabs. It's been in the industrial ecosystem around them. The specialty chemical companies providing the materials. The industrial automation companies providing the robotic systems. The electrical equipment manufacturers providing the power infrastructure for the new facilities. These companies sit 2 or 3 steps removed from the headline reshoring stories. But they're the ones receiving the purchase orders that turn policy into revenue. The 13F pattern, this industrial ecosystem category, has seen consistent institutional accumulation across multiple quarters, particularly from funds with long holding period mandates like pension funds and insurance company portfolios. Why this matters for 2027, reshoring projects have multi-year construction and ramp timelines. Companies receiving purchase orders today will be recognizing significant revenue through 2026 and 2027. The backlog visibility is high and the demand source is government mandated. This one requires the most nuance. Because fintech as a category has had a volatile few years. The easy money era fintech darlings came down dramatically from their 2021 highs. And a lot of retail investors got burned. But the 13F data shows institutional accumulation concentrated in a specific subsegment of fintech that is structurally different from the pandemic era darlings. The companies building financial infrastructure for the 1.4 billion people globally who remain unbanked or underbanked. And domestically, the platforms serving the roughly 22% of American households that are underserved by traditional banking. This isn't the same story as the 2021 fintech bubble. Those companies were competing with each other for the same already banked customers with slight UX improvements and venture-funded subsidies. The companies in the current institutional accumulation pattern are addressing structural financial exclusion with mobile-first infrastructure in markets where traditional banking has no footprint and no intention of building one. The unit economics are different. The competitive dynamics are different. The addressable market is different. And the regulatory environment, particularly in emerging markets where several of these companies operate, has become more favorable rather than less over the last 18 months. The 13F pattern, emerging market-focused fintech infrastructure companies have appeared in the holdings of several major global equity funds for 3 consecutive quarters, with position sizes growing quarter over quarter. The energy transition is the most written about investment theme of the decade. And because it's so written about, most of the obvious positioning has already happened and already been priced. What the 13F data reveals is institutional accumulation in a counterintuitive corner of the energy transition trade, the companies that make the transition possible, but that ideological framing on both sides of the energy debate has led the market to misprice. Specifically, the grid modernization companies. The transmission infrastructure operators. The companies building the high-voltage direct current lines that move renewable energy from where it's generated to where it's consumed. And the companies providing the grid storage technology that addresses the intermittency problem. The energy transition has a physical bottleneck that neither bulls nor bears are discussing clearly. You can build all the solar panels and wind turbines in the world. If the grid can't transmit and store the power they generate, the capacity is stranded. Grid modernization is the critical path item. And it's been dramatically underfunded relative to generation capacity. The bipartisan infrastructure law allocated $65 billion for grid modernization. That money is now beginning to flow. The companies positioned to receive those contracts have multi-year revenue visibility and the institutional holders know it. The 13F pattern, grid infrastructure and storage companies have seen some of the most consistent institutional accumulation in the dataset. 5 consecutive quarters of net buying from infrastructure-focused funds, utility sector specialists, and several major pension funds. Why this matters for 2027, grid modernization contracts are long duration. Companies receiving them now have revenue booked through 2027 and beyond. The demand isn't speculative. It's contractual. Here's where I need to be genuinely direct with you about what this data means and what it doesn't mean. 13F accumulation patterns are one signal. One input. They are not a guarantee of performance. Institutional investors are wrong. Sometimes spectacularly wrong. The same filing data that shows smart money accumulation can also, in hindsight, show smart money walking into a value trap or misreading a structural trend. What the data does is give you visibility into where patient, research-backed, long-duration capital is positioning. Not for a trade. For a multi-year hold. That's a different kind of signal than a stock tip. It's a directional indicator about where significant analytical resources have concluded value exists looking out to 2027 and beyond. The way to use this information responsibly is as a starting point for your own research rather than a conclusion. Use these categories as a research filter. Look at the specific companies within each category. Understand their business models. Understand their risk profiles. Understand how they fit into your existing portfolio construction and your personal risk tolerance. And then decide whether the thesis makes sense to you independently of the fact that institutional money is moving in that direction. Because ultimately the 13F data tells you what. It doesn't tell you why in enough detail to make an informed decision. The why is your job. Here's what I want you to notice when you look at these 7 categories together. None of them are exciting in the way that meme stocks are exciting. None of them are likely to triple in 6 months. None of them will get your group chat buzzing with emojis. What they share is something more durable. Each one sits at the intersection of a structural demographic or policy trend with a supply constraint or infrastructure deficit that can't be resolved quickly. That combination, long-dated demand with limited near-term supply response, is the setup that institutional money with multi-year holding periods finds most attractive. It's not exciting. It's not a story. It's pattern recognition applied to where the real money is actually going. And that pattern, historically, is a better guide than what's trending on financial social media at any given moment. The filing data is public. The Edgar database is free. The homework has been done by people with more analytical resources than most of us will ever have access to. All you have to do is read it. If this gave you a framework for thinking about where patient capital is moving before 2027, share it with someone who's still making investment decisions based on what's trending on their phone. I'm Money Sketcher. I'll see you in the next one.